Hey guys, today I'm going to talk to you about the process of buying a home. It is crazy, it's complicated, and it's so fun. I'd say one of the most important things is to have somebody that you can trust, that you can ask all your questions to. So what I'm going to try to do here is answer a bunch of them for you guys before you even ask, and hopefully make the whole process a little bit easier and a little less intimidating for you guys. So I have all my trusty notes here. There's tons to get through, so let's get started. Finding the right one. Not always easy, even if you're shopping by yourself. And when you've got two people, two sets of parameters, it's even harder. I'd suggest sitting down with your partner, the person you're going to purchase the home with, and just writing out all of the deal breakers. How many bedrooms? How many bathrooms? What kind of a floor plan? Is it necessary to have a pool? Stairs? Just take note of all those things that you really, really want in your house. And also, don't be too much of a perfectionist. This is your first home. Keep in mind that most people these days don't keep a home for 30 years, so you're not signing a deal that'll last till the end of your life. You can take a chill pill on that. For us, it was kind of easy because we both love townhomes. We both really, really wanted stairs. We needed at least 2 bedrooms, preferably 3 or 4. We wanted hardwood floors, stainless steel appliances, an open feel in the living dining space, and other than that, we weren't really that picky. Then we started checking out homes with an open mind and an open heart. The house we ended up buying actually was painted entirely in a combination of 2 colors, dark wine purple and a muted mauve. It was awful, and I'm kind of convinced that that's why more people didn't put offers on the house, so that ended up working in our advantage because we had a vision. Now, when you're looking at these houses, you're not just going to think, do I like it? Can I envision my life here? You're also going to be looking at the value of the home. And how is that determined? Look at the neighborhood, look at comparable sales. Most websites give you free access to all that information nowadays. It's important to look at price per square foot and compare that to price per square foot on properties that were recently sold in the neighborhood. Keep in mind, though, that maybe yours is way lower per square foot, but the property that just sold has all new finishes, redone bathrooms, new hardwood floors. That's not going to be the same as, bathrooms from 1970 and 30-year-old carpets. So yes, you're looking at the price per square foot, but you're also looking at the condition of those square feet. Once you decide that you really want a house, the next thing you do is put in an offer. Your real estate agent can help you decide if you should put in the offer a little bit lower or a little bit higher, depending on whether they think there's going to be competition. If you put the offer in $5,000 lower and somebody else came in on the same day with the offer, at exactly the asking price, they're going to give it to that person. So it depends on how much you really want the house and how much you really think the house is worth. We came in, what was it? Like $10,000 less than what they were selling this house for. And they came back with, how about $5,000 less and we'll throw in the refrigerator. So these kinds of things are very common. We said, okay, but as long as you guys help us pay for repairs. Namely the paint, which, believe it or not, was going to be really expensive because there's a lot of walls in here. And like I said, they were all purple. So once they accept your offer, what's going to happen next is they're going to send somebody to do an appraisal. I'm not sure if the appraisal comes first or the inspection, but basically the appraiser figures out if the house is actually worth what they're asking for it. And the inspector comes and says, hey, you know what? There's a leak in the gas pipe over here in the garage. Your back door isn't closing properly. They're basically on the buyer's side because they're going to come in and say, okay, the buyer offered this much money, assuming that the house was in perfect condition. So given that it's missing this, and this is broken, either give them that cash or lower the price. And more negotiations ensue. Once you get to a place where you're happy, you are going to have to put up some earnest money. In our case, we put down $1,000. At that point, if everything goes smoothly, then you have no reason to get your earnest money back. If you, for some reason, out of the blue decide that you don't want the house, you're going to lose that $1,000 because you put it up saying, yes, this is my intention to go ahead and buy this house. If they fail on their side, then you can get your earnest money back. And if you do end up purchasing the house, the $1,000 goes toward the closing costs, which is a whole other ballgame. But let's talk about qualifying for the loan. What kind of a price range are you gonna look at when you're looking for homes? This is super important, and I'm gonna talk to you guys about 2 different ratios. We've got the debt to income and the loan to value, and these basically determine how expensive of a house you're gonna qualify for and how much your mortgage payment is gonna be once you get it. So yes, when you're qualifying for the loan, they're gonna look at your credit score and your income. That's why a lot of people go in on a loan together. Here's something you need to keep in mind though. If you want them to consider both of your incomes, they're gonna also consider both of your credit scores, and unfortunately, they're gonna go with the lower one. So if the one of you with higher credit can qualify for the loan on their own, this is a better option. However, in order to qualify, like I said before, they're gonna look at your debt to income ratio. And in layman's terms, this basically means what are your monthly debts and what is your monthly income, your debts need to be below 45% of your income. So for example, let's say you have a couple of credit card payments, a car payment, and what else do people have to pay? Insurance payments that all add up to $500 a month. Then you're looking at a mortgage payment that's going to be around, let's say, $2,000 a month. That means that your monthly debt payment would be $2,500 a month. So you have to be making more than $5,000, $5,500, give or take, so that you can qualify for the loan on your own. Now, something that would change this would be if you're coming in with a significant down payment, and that also has its benefits, which I will go ahead and touch on right now. At least here in Texas, I don't know how the other states work, but if you come in with 20% down, that will remove the need for you to pay something called a mortgage insurance. And this is not home insurance. Everybody has to pay home insurance. But a mortgage insurance is something that you have to pay additionally to the bank to basically ensure that you're not gonna run away from the whole loan and the house and everything. Right now, if you don't have anything invested in the house, it's not gonna cost you that much to run away from it. It's just gonna ruin your credit. A lot of people are willing to do that, as we found out in 2008. So again, the state of Texas requires for you to pay, in addition to your home insurance, a mortgage insurance until you have 20% equity in the house. That's why it's super, super helpful to come in with 20% down. So not only will that eliminate the need for a prepaid mortgage insurance, it will also lower your loan to value so that you can qualify for a lower interest rate. Let me clarify on that. Loan to value is basically how much is the house worth and how much of it do you owe. So if you have 20% down, you owe 80% of the house, right? The bank sees that as, okay, this person is pretty well invested in the property. They're probably not gonna run away. I'm gonna reward that with a lower interest rate. And if you guys saw the sheets that all the lenders come in with to all of the brokers, you would go crazy. I actually worked in loans for like 3 months or something. It was crazy, but I'm really glad that I learned a bunch of little tricks. This is something to note. When you are financing your home and you see that the broker is going to charge 1 point, which is pretty standard, it means 1% of what is going to be financed. So if it's $300,000, they're going to charge $3,000 as sort of their fee for doing all the paperwork and gathering all the information. If you're going to be a stickler about that and say, no, I don't want you to charge me a point, I want you to charge me half a point, guess what? They're going to figure out a way to get their money anyhow. Now on these charts, oh my goodness, they have credit score on the charts and they have loan to value on the charts. So the higher your credit score, the lower interest rate you'll qualify for, and also the lower your loan to value is. So if my credit is above 800 and I only owe, or I'm gonna only be financing 80% of what the home value is because I'm putting a 20% down payment down. That sounds weird. The bank is gonna look upon that favorably and give me the lowest interest rate possible, unless I'm being a stickler with the loan officer and saying, hey, I don't want you to charge me anything. They have a system where they can say, okay, look, no, I'm as you can see, I'm not charging you anything here. But they're getting their money on the backside. How does that work? You probably qualify, let's say, for a 3.5% interest. They're going to give you a 3.75% interest and tell you that that's what you qualified for. And the lender will reward them for that because in the long run, they're going to be making thousands of dollars off of you with this higher interest rate. Yes, interest rate does matter. And that brings me to my next point. It might be in your best interest to pay down the interest rate. What does that mean? Do your research, first of all, guys. Don't just go with the first thing that any loan officer tells you. Check out different banks, different institutions, different lenders, and see what you can qualify for based on your credit score, how much you're going to be putting as a down payment, and what your income is. We actually did buy down the interest rate because it just, it frustrates me to be spending so much in interest. If you actually look at how they front load the interest on these loans, because they're calculated throughout 30 years, the first couple of months, actually the first couple of years, you're paying more in interest than you are in principal. So out of $800, $500 is going to interest and $300 is going to principal. Actually, let me recommend an app for you guys. It's called Zillow Mortgage. It is so helpful. You can go in there and put payment calculator, you put the price of your home, the down payment if you put any money down, the interest rate that you qualified for, the property taxes, the homeowner's insurance, and then the HOA dues if you have any. These are all the things that get factored into your mortgage payment. And they show you, it's really cool. Out of your payment, say $1,500, $900 is going to principal and interest, and then you can actually see how much is principal and how much is interest. Again, more interest than principal, unfortunately. Property taxes, which Texas has super high property taxes, and I'm not happy about that, and how much is going to home insurance. So for everyone that's like, Stop renting, stop throwing your money away. It's going into the trash can. You need to start investing in a nest egg. Guess what? Out of a $1,500 payment, only $300 a month at this point is going to the actual principal. But I'm gonna tell you why I think a home is a good investment anyway. And it's not just what I think, it's the truth. First of all, because house prices generally go up. Say you bought the house at $300,000. In 10 years, it's probably gonna be worth $340,000, $350,000. Also, you can make upgrades to increase the home value. So if you got it with kind of crappy plastic countertops and you replace them with marble or granite, or you put a really nice stainless steel backsplash, or you redo your bathrooms, all of that is going to add value to the home. And at the end of the day, a house is worth what someone's willing to pay for it. Another reason why a house is a good investment is because your interest and your property taxes are tax deductible. So all of that money that we were talking about that you feel like you're throwing away, well, you kind of are, but at least you're not going to get taxed on the income that's being used to pay for it. So your tax returns are going to be a lot chunkier, let's just put it that way. So back to buying down the interest rate. Why would anyone do it? Well, it turns out that if you're going to keep the house for more than a year, it's usually worth it if you can cough up the money in the beginning. So I think that we had qualified for a 3.75 interest rate based on income, credit scores, all that good stuff that I was talking about before. Agustina, but we really wanted to lower that interest rate. So we paid 1 point to lower it from 3.75 to 3.5. And if you start calculating how much you're going to be paying in interest with a 3.75 interest rate versus a 3.5 interest rate, you'll find out that within 13 months, I believe, you have already made up the difference that you paid initially. And after that, it's all savings. And for some reason, it just really, really irks me to feel like I'm paying so much in interest. So that's something that we chose to do. And now we have a 3.5 interest rate, which is pretty good. Another thing to consider is whether you want to finance over 30 years or 15 years. Most people go with 30 just because the payment's a little bit lower and it's just a lot more manageable. But really, if you look at it, the 15-year payment is not double the 30-year payment like you'd think it was. And the amount that you end up paying in interest is way, way lower if you do your loan over 15 years. It just depends on how expensive the home is that you're trying to buy. The advice that I would give you, if you don't want to do a 15-year loan just because you're forcing yourself to have to cough up that, higher monthly payment every month, you can make additional payments per month. Make sure there's no prepayment penalty. I don't think that lenders do that anymore. They used to. But you can just cough up a couple $100 extra every month and send that straight to principal. It just feels so good knowing that you're going right into what you owe, and they're not going to be able to calculate new interest on that amount because you don't owe it anymore. So in the long run, it really, really, really helps if you can, throw in a couple extra $100 toward principal every single month. Also, do you want a fixed rate or a variable rate? A lot of people run the other way when they hear about variable rates, but it's actually not that scary. Most of them have a period that it's going to stay fixed, and then after that, it's going to adjust to the market. It actually might be lower. So, if you want to take the risk, if you're kind of a gambler, it might be the choice for you. Also, if you know that you're going to be refinancing within 5, 7, 10 years, then, what's the point of paying a little bit more to get a 30-year fix if you know you're going to be doing a transaction on the home in the next couple of years? I am really excited about these numbers. As far as the process goes, guys, you're going to have a lot of patience. It's pretty time consuming. You're going to be emailing back and forth with your loan officer, with your real estate agent. They're going to be asking you for all the documentation in the world, your birth certificate, all of your pay stubs, your bank account, they want to see all your transactions. Actually, it ended up not working in my favor that in the, previous living situation, I would make a lot of the payments and the guys would send me the money. They saw that as, I wasn't making enough money to survive on my own because people kept wiring me money. So, they get a little weird when they're trying to qualify you for a loan. Also, they look at your last 2 years of employment history. So if you're making good money now but you weren't last year, they're going to find an average between the two and based on that determine what you qualify for. Gosh, I had so much to talk about and I feel like I covered most of it. At the end of the day, buying a home is a risk, just like anything in life, but it is generally a good idea. You're going to slowly be adding a little bit of money toward your nest egg. You can make changes to the home, buy furniture that's perfect for the space. No more feeling like a nomad. I feel like I've had that, for all of my life, sort of this nomad, resident of nowhere mentality. And yes, it's intimidating to think that you have something that's tying you down, but at the end of the day, most of us have been paying rent for all of our adult lives and that hasn't killed us. So for all of you that are considering buying a home, I hope that this helped you guys a little bit, gave you a little bit of orientation. And again, don't just rely on this video, do your research, talk to your people, and I wish you the best of luck. Thanks for joining me, guys. Talk to you later.